Assalamualaikum and hi. Our Group H5 will present Chapter 4 Performance Measurement. The topic given to us from our dear lecturer, Madam Suhaili, is a cost-based transfer pricing specific to variable cost per phase fee. This is our teammate from Group H5. The first one is myself, Norfarah Qayyum, Binti Muhammad Suhaili, metric number 280853. Next, Nur Shafina Binti MD Rosli, metric number 281094. Teo Jawan, metric number 281254. Muaz Nabil bin Muhammad Tarmizi, metric number 280863. Aida Zahira binti Ismail, metric number 281448. And lastly is Nur Raihan binti Mazri, metric number 281392. Next, transfer pricing. Now, I will talk about the definition of transfer pricing. Transfer pricing can be defined as the value which is attached to the good or services transferred between related parties. In other words, transfer pricing is the price that is paid for a good or services transferred from one unit of an organization to its other unit situated in different countries. Pros and cons of cost-based transfer pricing. Now, I will present about advantages of cost-based transfer pricing. There are several pros of cost-based transfer pricing. Firstly, it takes a few resources. Cost-based transfer pricing doesn't require a lot of additional market research. Cost of production is something businesses are mostly aware of by adding up different invoices and labor costs. Businesses can then take the sum costs and place a margin on the top of them that they believe the market will bear. It's a pretty simple, and for this reason it's a popular strategy among small businesses or a business where other aspects of production must take precedence. Secondly, it provides full coverage of cost and consistent rate of return. Cost-based transfer pricing ensures that the full cost of creating the product or fulfilling the service is covered, allowing the markup to ensure a positive rate of return. Yet, often there are many additional costs that can be accounted for, which result in reduced margin. Fortunately, by increasing the margin, businesses can create a buffer against uncalculated costs and fluctuations in demand. Additionally, because of prices remain inert, it can easily estimate revenue for a given month based on convention history and marketing spend. Thirdly, enhance again incomplete knowledge. Cost-based transfer pricing is especially helpful when companies have no information about a customer willingness to pay, and they are not the direct competitor in the marketplace. Besides, the only data have to guide pricing decision is the calculation or the estimation of cost, which allow to push forward at least a starting price to work from as the market and customer develop. Next, it is useful when setting prices for a low risk and innovative items. Also, it is helpful to the accounting officer to make a price decision, for instance, to use the correct return on investment (ROI). Lastly, by monitoring the cost of production, cost-based pricing ensures that they recover all incurred costs. Basically, there are 6 pros applying cost-based transfer pricing. That's all from me, Farah Qayyum, and I will pass to the next presenter.
Hi and Assalamualaikum. I am Aida Zairah Binti Ismail. My metric number is 281448. I will present about the disadvantages of cost-based transfer pricing. Just now, we presented several pros of this method. However, there must be some cons when applying this cost-based transfer pricing. First of all is that this method does not offer any incentives to a firm. Besides, a firm also may lose some opportunities for them to charge a higher price in the external market when they implement this cost-based transfer pricing. Lastly, this method does not recognize the impact of the forces for both of the demand and also the supply. Basically, these are the three main points that our group highlighted for the cons of applying cost-based transfer pricing. Before we move to the next part, I will explain further about the three highlighted points just now regarding the disadvantages in the implementation of cost-based transfer pricing. When we say that cost-based transfer pricing does not offer any incentives, it means that this approach could remove the motive of a company to be more efficient. Additionally, the second point is about the firm may lose some opportunities to charge a higher price in the external market. This is because cost-based transfer pricing does not take any benefit of the market potential. This second point also indicates that a company must be aware of all the costs that they will incur in the process of setting the price. This is because overlooking to any cost can lead the result in underpricing. What does it mean when we talk about the market potential? A simple example is that when a new and innovative product were introduced in the market, such as iPad, there might be no potential for the firm to charge a higher price when using this cost-based transfer pricing approach. Lastly, cost-based transfer pricing does not recognize the impact of the forces of the demand and also the supply. It is more focused to the demand itself. This cost-based transfer pricing method does not take into account the demand and also the competition. When we ignore the demand, it will be inflexible when there are changes in the level of the demand itself. Why it is inflexible? Because the price will not change although there are changes in the demand level. Other than that, disregard demand and price elasticity of demand will reduce the importance of consumer and also reduce the bargaining power. There are three approaches under this cost-based price method, and our group will present one of it, which is the variable cost per fixed fee approach. Variable cost per fixed fee approach under this cost-based transfer pricing, also known as variable cost-based pricing. It involves and transfer the production cost, which consists of direct material, direct labor, and also the variable factory overhead. This approach is useful for a company when the selling division is operating below its capacity. But the drawbacks of this approach is when the transfer price might not be recommended because it could not generate any profit to that specific division. However, this variable cost per fixed fee approach can gravitate the maximum profit for the entire company. This is because when the production and pricing decisions will be based on the cost volume profit relationship for the firm as a whole, when the firm only passing the variable cost alone to the next division. Variable cost can be defined as the cost of producing that one extra unit, or we can define it as the cost which varies based on the quantity. This variable cost-based pricing allows a company to set the price directly from the variable cost. As I mentioned earlier, we have to consider the additional of labor and also the materials when using this approach. We don't need to consider about the equipment or processing because it is already taken into the account. All of the costs involved will be added to the markup, which is accounts for recouping any fixed costs that can make an addition to the targeted profit for a company. That's all from me, Aida Zahira, and now I will pass to the next presenter.
Assalamualaikum and good day. Thank you Aida Zahira for presenting the previous slide. My name is Norfarah Binti MD Rusli, metric number 281094. I will continue presenting the concept of variable cost per feed fee and the cost-based transfer pricing. When we use this method, the first thing that we need to think is what is the problem that will arise. This can be seen in the selling division that is left holding all of the operating expenses and fixed costs. Thus, it will not be able to mark up its product or services, and as a result, will not be able to generate a profit. It's become a loss division. Why selling division as a cost center? This can be seen through its performance that is being judged on the basis of cost variance, due to the division itself which cannot really be judged on its commercial performance. It is impossible to make it as a profit center. Other than that, producing the division also does not necessarily recover the fixed costs. So, how do we overcome it? Price or transfer at variable cost while also charging the buying division with a fixed fee. Fixed fee can cover the selling division fixed cost plus a return invested capital. For the next part, I will continue presenting the definition of variable cost for fixed fee and the cost-based transfer pricing. What is variable cost-based pricing? It is a pricing method whereby the selling price is established by adding a markup total to variable cost. What is a markup? Markup shows how much more a company's selling price is than the amount the item costs the company. In general, the higher the markup, the more revenue a company makes. Markup is the retail price for a product minus its cost. Other than that, what is the expectation? The expectation is that the markup will contribute to meeting all or a part of the fixed costs and yield some level of profit. Variable cost-based pricing is particularly useful in competitive scenario, such as contract binding, but it is not suitable in situations where fixed costs are a major component of total cost. Next, I will present on how this method works. The figure compare variable cost pricing with borrowing all cost plus pricing. It shows that it's discard fixed costs altogether. For the old method is variable cost per unit plus fixed cost per unit. Then we get the observation cost. After we get the observation cost, we will add up with markup price. After that, we get the sale price. But for the new method that is variable cost per fixed fee, just need to add variable cost per unit plus markup price. After that, we get the sale price. This is easier and simple. Last but not least, we will talk about the important when using this method. The first important thing that need to be noted is it is not suitable for a company that has significant fixed costs or fixed costs that increase if more units are produced. Any markup on the variable cost on top of the fixed cost per unit might result in an unsustainable price for the product. Second is, it is suitable for a company when a high proportion of total costs are variable. A company can be confident that its markup will cover fixed costs per unit. If the ratio of variable cost to fixed cost is low, meaning that there are considerable fixed costs that go up as more units are produced, the pricing of a product may end up being inaccurate and unsustainable for the company to make a profit. The last point that need to be noted when using this method is to earn a profit, your sale must exceed cost. But because variable cost pricing doesn't fully account for fixed costs, it can trick manager into setting prices so low that they hurt profit or worse yet cause net losses. For example, selling a room for 52 ringgit may increase the profit. However, selling too many rooms at such low prices, even if you never at full capacity, will loss a lot of money. That's all from me. Thank you. I will pass to the next presenter.
Good day everyone, my name is Teo Jia-Wen, number metric is 281254. Now I'm going to continue present my part. Let's begin with example of variable cost based transfer pricing. Let's say we got a company called Gestor Automotive, and this company produce car and they have multiple divisions. For this example, we look to the battery division and automotive division. The battery division that manufacture batteries, and those batteries could be sold to some outside firm, or they could be transferred to the automotive division within the same company that produce the car right now. So the automotive division could get the batteries from the battery division. And then the question is, what is the price that the battery division should be allowed to charge the automotive division for the batteries? So when we use the variable cost based transfer pricing, it actually could mean a number of things. So one price that could be charged by the battery division would be the variable cost. Let's say the variable cost to produce a battery is Rm55. It means Rm55 is the price that the automotive division would pay if they were willing to go along with it. Next, what is the calculation of variable cost based transfer pricing? Step 1. We need to determine the total cost of production of a given product or service. The total cost is the sum of the fixed cost and variable cost. Step 2 is determine the unit cost by dividing the aforementioned total cost by the number of units produced. Step 3 is determine the selling cost by multiplying the unit cost by the predetermined markup percentage. Now we look to another example. A company manufacturing electronics with division A, that is manufacturing TV plasma screen, while division B manufacture the television. Assuming the variable cost of producing a unit of the plasma screen are labor cost Rm200, direct raw material Rm400, and overhead cost is Rm100. So the formula would be all variable cost, that is Rm200 plus Rm400 plus Rm100 equal to 700. This answer is based on if the company set the cost transfer with the variable approach. So they will set the transfer pricing at Rm700. That's all for my part. I will pass the presentation to my next member. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nabi bin Muhammad Tamizi. My metric number is 28063. I am from Group H. Now we take a look to the example. For this example, suppose that Spark Industry made the Red Rover model. The entire production runs of Red Rover requires 900,000 ringgit worth of fixed cost. For each unit cost another 90,000 ringgit occur in the variable cost. So in this case, Spark Industry wants to earn 400,000 ringgit in the profit on the production and the sale of 20 units of this model. So firstly, we need to figure out on how much markup that Spark Industry needs on each of unit to cover both of the desired profit and the fixed cost. For that, we know that the desired profit is 400,000 ringgit and the fixed cost is 900,000 ringgit. So to get the markup is the desired profit plus with the fixed cost that been divided with the unit, which is 20 units of unit produced, and we will get the markup price is 65,000. So now we have got the markup price, which is 65,000. Then for the set price that we need to put, we need to plus the variable cost with the markup price, which is 9,000 ringgit, plus with the markup price 65,000 ringgit, and now we got the sale price is 155,000 ringgit. So Spice Industry must sell their Red Rover at the price of 155,000 ringgit to get cover their both variable and fixed expense. That's all. Thank you. Now we move to the next example. Suppose a manufacturer use a variable cost plus pricing to develop a quote for a purple widget. The variable cost to produce one of those widgets is $20. Meanwhile, the firm use a 40% of markup percentage. So the result on the quarter price is when we multiply the variable cost with the markup percentage, which in this case is $20 for the variable cost that occur, and also 140% for the markup percentage, which is 1.4. And when we multiply both of them, 20 multiplied with 1.4, we got the quoted price is $28. Other than that, the company also has fixed costs that allocate at 6 ringgit per unit. This bring total cost to 26 ringgit, which the variable cost plus with the fixed cost that we got earlier, with the fixed cost with the price that we got earlier, which is 28 ringgit. This means the company earns 2 ringgit for each unit of widget that been sold, which from we got the total cost, which is 26 ringgit minus with the price 28 ringgit. So the company earned $2 for each unit that been sold. Now we move to the next. There are also pros and cons of the variable cost per fixed fee under the cost-based transfer pricing. As for the pros, this approach can work well when the variable cost comparison of this approach can work well when variable cost comparison of the bulk of all costs incurred. It also can be used when a company not incur any additional fixed costs for each additional unit sold, when a common occurrence when there is excess capacity. In this case, variable costs are the same as the total cost, so the effect is the same as would be case for the cost plus pricing. Next, the cons. The cons for the variable plus pricing is it can result in unusual outcome when variable costs comprise just a small proportion of total cost, since the markup multiplier may result in unusually high or low price. Generally, it is better to base price on the going market rate, since this maximizes the profit. If a price is set too high with the variable cost plus pricing, then the customer will not buy the product, and if the price are set too low, then the company is losing the profit that might have earned if the profit has been set at the market rate.